Good evening, everyone. This is Denise Fuentes with Marshall Reddick. Tonight we have Scott Pastel from the VP Marketing here at Marshall Reddick, and our insurance agents who we have partnered with for many years, who will be joining and talking later on during this presentation. Tonight we're talking about a very timely subject. Marshall Reddick is located, I'm located in Newport Beach, California, and have several people joining us throughout the United States, but I'm sure everywhere you are all aware that we've had natural disasters happening with the fires here in Southern and Northern California, and it seems to be more frequent occurrence throughout the states, and it's tonight we're talking about a very timely subject, something that should concern all of us who have assets and property, asset protection and insurance for our rental property. I am sure you're going to find all the information that we're going to share with you this evening helpful, whether you are a beginning investor just considering starting your investment portfolio, or a seasoned investor and you already have property. You're going to find the information valuable in getting the right start, making sure you are insured properly with your beginning portfolio or existing portfolio, making sure that you're not leaving anything out that you should be concerned with. So let me start off. As I said, tonight we're having people join us of all different levels, and let me start off by telling you a little bit about Marshall Reddick for those of you who are not familiar with us. We are a one-stop shop for all real estate investment. We're a full-service brokerage here in Southern California, and we can assist our clients in buying and selling property throughout California. And we also have affiliate real estate agents throughout different markets outside of California that we work with, and then we can assist you in acquiring property outside of California as well. We also have a private money lender division, and that's a separate division that we would be happy to connect you with if you're interested in doing more passive investment. And we also have a third division, property management division, that is also headquartered here in Newport Beach, but we also have a second office that does that. We have different markets where our property management is also operating outside of California, not just California. But we make it possible to purchase property and take care of everything from A through Z for you in California and throughout different markets that we have identified as great markets for from an investment point of view. So that's a little bit about Marshall Reddick. A little bit about me, just a name. I am a licensed real estate agent here in California and an advisor with Marshall Reddick. I've been licensed representing buyers for over 4 years. I have had personal experience owning and renting properties myself for myself and my family. And I've been married for quite a few years, have a couple of children. When I'm not working, I love to cook, dance, hike, do all the great things that you get to do when you live in Southern California and when there's no big fires going on. But that's a little bit about me. What I like to do now is introduce Scott Pastel and have him tell you a little bit about the criteria that we look at as far as when we choose the different markets that we take our investors to and present opportunities to that we have vetted for great investment opportunities. Without further ado, Scott.
Yep, thanks a lot, Denise. Yep, appreciate it. So yeah, we're talking about insurance, but I think it's also good with Marshall Reddick's background and services in real estate investing that we kind of talk about some of the real estate investment markets that we recommend, that we own property in, that we've sold properties in for many years and do property management in. And just really briefly, you know, right before we get to the insurance piece in just a couple minutes, this is our Marshall Reddick's exact criteria of where to invest, I think you can agree that not every city and every state or every neighborhood or every property actually makes sense for an investment. We're talking tonight about how to properly insure and protect our assets. Well, it's also good to know what are the right types of properties that make sense for investors. What are properties that are easy to insure, that won't have excessively high fees for coverage? You know, what are the types of properties that insurance agents like insuring? Low risk, you know, just very kind of standard, easy properties to manage. So the majority of the properties that you'll notice on our website or that you'll hear us talk about are generally going to be 3 to 4 bed, 2 to 3 bath, 2 car, single family, detached homes. We do not believe in rental properties that have pools. We don't believe in rental properties that have rare exceptions and just uncommon, unique components. They're very, very, very normal properties. And these are the types of properties that are easier to rent. These are the types of properties that are in high rental demand. These are also the types of properties that come along with a little bit less risk than properties that have a lot of unique features. So when it comes to how we choose the different markets that we're located in, this is the criteria that you see on your screen that we stick to. First and foremost, all of the areas we cover outside of California, from Texas to Tennessee to Florida, Arizona, Indiana, these cities are some of the strongest job markets in the country. These are locations that have the fastest job growth. These are locations that have the strongest job demand. These are locations that are adding the most amount of jobs. And with jobs comes more demand in the housing market. And that's beneficial in the rental market. It's also beneficial in the real estate market, because more people moving and buying properties pushes home values up when there's more demand. More people moving and renting properties makes more demand for rents and pushes rents up. So you can see how important the job market is, because that type of demand has a direct impact on rent values and home values. So with that demand allows us to keep our vacancy rates lower. You'll see that all the markets that Denise is going to show in a minute are in major metropolitan markets. A lot of them are state capitals like Austin, Texas, Indianapolis, Indiana, Phoenix, Arizona, Boise, Idaho, a lot of state capitals. And major metropolitan markets, including state capitals, are going to have a wide variety of diversity in employment. What I mean by economic diversity are a significant amount of jobs in many, many, many different industries, from government to education, healthcare, trade, manufacturing, agriculture, technology, so on and so forth. You're going to see, with economic diversity comes stability. And when we're owning rental properties on average for 10 to 15 years, we want stability in not just now, but in 5, 10, 15 years from now. We want to avoid a major regulation, moratorium, or a major change in any one of those industries affecting the real estate market. So with more diversity of employment means more stability if there's changes in any one particular job industry. Next is housing affordability. Well, that's obvious. We're investors. We want the most bang for our buck. We want to be buying properties and locations where we can get the highest amount of rental income for the lowest amount of purchase price. So the U.S. median home price average right now is in the high 200,000s. About, I think, 280 to somewhere to up to 300,000 is the U.S. home price average. Most of the markets that we're located in have median home prices from about $150,000 to $250,000. So with that type of affordability, gives us the opportunity to scale our portfolio, buy multiple properties for maybe the same price that we would purchase in a lower affordability market. And we're essentially able to increase our rental income for a much lower purchase price. Also, when we're buying and owning properties that are at or slightly below the median, it also opens us up to the largest percentage of the rental population in that particular market. So for us, it's all about sticking to properties that have very high rental demand, attract high quality tenants, and are located in markets that will continue to see that job growth, so we can continue to not just keep that property rent, but also increase over time. Next comes landlord friendly with a question mark. Landlord friendly, I guess is how you would say that. Not every state is considered landlord friendly. The landlord tenant laws, the housing laws are different by each state. And outside of California, I have to add that caveat that outside of California, the markets that you'll see us with properties in are considered very landlord friendly. Landlord friendly means that a judge, when there's a gray area, will have more likelihood to side with the landlord than the tenant. If there's a dispute, if it's sort of in the gray area, some of the examples of what would be considered landlord friendly or tenant friendly, in landlord friendly states, the eviction process comes with a lot less red tape. It's a much faster, more streamlined process. Here in California, I think the average eviction takes a minimum of 3 months. Also, you don't see rent control in landlord friendly areas. You will have more time to refund a security deposit than you would in a market that's tenant friendly, where we may have to get them their security deposit much faster. So these are just a few examples. So through that research, we've identified markets, cities, states that are considered landlord friendly. Next is strong education. So because we're in major metropolitan markets, we see a lot of very, very prominent universities and colleges mixed in these towns. Those colleges and universities attract students who in the future end up joining the working population, the job market. So we know in places like Austin, where there's University of Texas with over 50,000 students, and in places like Indianapolis, Fort Myers, Florida, very, very well-known colleges that attract students. And the idea is for those students to stay there after they graduate and join the workforce. Next is the reliable property management, and that's where Marshall Reddick comes in. So Marshall Reddick has boots on the ground in every single market that Denise is about to show. We do the property management for our clients, one-stop shop. And for us, we believe that property management is really the make or break factor when it comes to owning rental property. And I believe that asset protection is an equation that looks kind of like insurance plus property management equals asset protection. When Stan and Michael momentarily go through the ins and outs of landlord insurance, how to have the proper coverage, really the big overlying theme is asset protection. How do we protect ourselves from worst case scenarios? Property management is just like insurance in that it's there to be the buffer to reduce our risk and to ensure a smooth, low risk, low maintenance investment. So that's where Marshall Reddick comes in. And Denise will go ahead and show the slide of all the properties and all the markets that we cover.
So if you are looking at our slide here, this is where Marshall Reddick currently does business in. We have teams in 16 major metropolitan markets, as Scott described, that fit the criteria that we very carefully look at. We have established relationships in all of these markets with we either have our own people in the areas where are boxed in red, our own Marshall Reddick agents and our own in-house property management, or we have relationships with agents and property management companies who we've worked with for years, as we have with Stan and Mike, who are going to speak next in the insurance field, who we've worked with for years and have helped our investors with their needs in acquiring and maintaining their investments. So all of these markets are markets that have been vetted by Marshall Reddick to fit the criteria that Scott carefully just described. We have our office is our corporate office where we're talking to you from today. It's in Newport Beach, and naturally, because we're in Southern California, we cover all of California. We have property management for all of our clients who own property locally here, and if they need to buy or sell, we can assist you with those needs as well. And we also have an office, a Marshall Reddick office in San Antonio and Clarksville, Tennessee, San Antonio, Texas, Clarksville, Tennessee, and we have our own in-house property management in those areas as well. Like I said, in all the other areas, such as Phoenix, Arizona, Fort Myers, Tampa, Boise, Indianapolis, Las Vegas, Memphis, and Dallas, we have established relationships with local area experts who we've worked with and who will be happy to help you if you're looking in that area, or if you have investments in those areas and you're looking for someone to manage your property. We have all the relationships with the necessary people to make sure that your properties are taken care of. So these are our markets, and what I'd like to go over next is what I do here with Marshall Reddick. Some of you that are on our webinar tonight may already have been through this process, so you'll know what I'm talking about. My role as an advisor with Marshall Reddick is to assist you in identifying what market out of the ones that I just showed you make the most sense for you as an investor to help you accomplish what goals you're trying to accomplish. No investor is the same. Everyone's looking to achieve different things, and they're looking to reach different goals in different timelines and different places. And so everyone's criteria is quite different. So I am here to help you in any way I can in determining, first of all, we have to look at the basics. Why are you looking to invest? Set your goals, start from the beginning, and figure out what, based on what it is that you're trying to accomplish, figure out how you're going to accomplish those goals and how we can assist you with those goals. What options do we have for you that can help you accomplish those goals? What properties fit your criteria? And then we decide, what kind of timeline are we looking at? What's your goal? Where are you trying to go? What do you need to do between now and then to reach your goal? So we'll figure out a plan for you to start investing or continue your investing and looking maybe at new options, new areas that you had not considered before, and setting your criteria, looking at what would make the most sense for you, identifying the market. Every market that we are in, it has different strengths and provides different advantages, I would say. They all fit the criteria that Scott described, but they're all a little unique in their own little way, and they're going to provide you different things. So we'll look at that and see which one makes the most sense for you. And then finally, we introduce you to all the key players that will help you make that happen. We have developed relationships in many years, such as Stan and Mike, who I'm going to talk to you next. For over 20 years, we've been working with them, and they have insured thousands of our clients, of our investors. So they're trusted affiliates that we work with. We have the lending partners, we have attorneys, CPAs, insurance agents, local area experts, everything that you're going to need to help you attain your investment goals. And that's what I do. So I am here for complimentary consultations. If you would like to sit down and go through this plan that I just described to you with me, I will be happy to talk to you and guide you along and see if it's something that will be beneficial for you, and we can work together, put you in touch with all the right people to get you started. The next screen here, I want to show you a typical, this is one of our investors' timeline, how she started her portfolio. And it's just to give you an idea. Like I said, no investor is the same. Everyone has different goals and different capital to work with, different criteria. And Kristen is one of our investors, and this is how she built her portfolio. And it just gives you an idea what different ways you can do and what different areas, how she balanced her portfolio in different markets that we currently operate in. She first started in 2006 with a condo in Scottsdale, Arizona. Bought it for $180. The current value is $165. As you can see there, she bought it right at the peak of the market. So, you know, that she's still holding on to that. After that, in 2011, she bought her home, a single-family residence in Indianapolis, for $105. The current value of that is $133,000. In 2012, the very next year, she acquired her next single-family residence for $105 in Indianapolis, and now it's worth $129,000. She also did some lending. She worked with our private lending division and was able to make some extra cash there by lending some money, $16,000 in 2016, a little over $16,000 for a 10% return. And in 2015, she bought a duplex in Lehigh Acres, which is another one of our areas, for $115,000. In 2013, in 2013, she bought a single family in Memphis, Tennessee for $110. It's currently worth $149,000. And she did another loan in 2016. In 2017, she sold the duplex that she bought in Lehigh Acres so she bought another duplex for $188,000. And so this is her portfolio. This is how she's gone about building her portfolio little by little. There's no, it's not like every year. She didn't start off buying everything in one year. She just went at her own pace and has been building it, and is hoping to hold on to it for a while and just keep growing it. So this is just an example of one of our investors. To give you an idea of different scenarios different routes that you could take with the different markets that we work with and different services. So now it's time for a poll. I would like to just get you guys to participate for a second, wake you up if you're falling asleep, get you involved. This is completely anonymous, and I would like to get your I'll take a few seconds for you to respond. This is anonymous again. Feel free to just fill it in, and I'll share the results at the end of the poll to see who we have online. Okay, well, thank you so much for participating. The poll is closed, and the question is, how many rental properties do you currently own? And we had 34% of our attendees said none, so that's interesting. That's great. Like I said, a lot of the investors, that we have online are just starting out. 27% said they own 1 to 2 properties, and that's great also. It's a great information that you're about to hear that's going to be very helpful, like I said, to get on the right track, make sure that you're covered with everything, and that you're not paying too much, too, that you're not covered for the wrong things. 11% said they own 3 to 4 properties, and 27% own 5 or more. Thank you so much for sharing that information. It makes it a little more fun, and it gets you to participate. And now, without further ado, I'd like to introduce to you our guest this evening. 1 second here. Okay. Mike and Stan from Huggins and Dreckman Insurance, like I said, they have been partners with Marshall Reddick with us here for over 20 years. They've helped thousands of investors, are extremely knowledgeable in the area of insuring your investments. They speak real estate, they're investors themselves. They have extensive experience and can understand and see things from an investor's point of view when insuring your property. They can answer your questions intelligently and speak to you in a sense that it makes sense when you're talking to them about your investments. And also the beauty of working with them is that they can help you in any of the states and any of the markets that we currently work in. So without further ado, I'd like to introduce Mike and Stan. Mike and Stan, are you there?
We are here, Denise. Thank you so much. This is Michael McAllister, and I'm here with Stan. Hello. As Denise said, we have been licensed agents over 37 years. I worked in property management and real estate sales for about 20 years. I've been with Huggins Dreckman now for several years. So when we say we speak real estate and insurance, we really do. We understand it. And as Scott said earlier, there are certain properties that are easier to insure. And honestly, Marshall Reddick, the portfolio that they pick out, those are a lot of the properties that we look at. We're going to go in depth on a lot of the things that we look at, and we're going to give you some tips this evening on what you want to look at when you're buying these properties and some of the things that make it easier to insure. So we're going to start with the purpose of insurance, and I think we all kind of realize the purpose is to protect our assets, make sure that if an event does happen, we can rebuild our asset and continue to get income. When we do that, though, there are a lot of things that you need to look at. It's not just making sure you're insured that you can rebuild it, but there's a lot of things in between that we're going to show you this evening that will help you out. Okay, so landlord insurance, a lot of what Marshall Reddick does is 1 to 4 family homes. Those are the ones you really want to look at when you're buying them. The insurance is going to cover your primary structure. You're going to have contents if you purchase it. It is a little additional, but those are going to be your things like your refrigerators, your washer dryers, your microwaves. Then you come into your loss of rental income. This is a very important item. This is where if something happens to your home and it has to be rebuilt, you will get income during that time when the renter is not at the house. Okay? And then you've got your liability protection. In case you're sued, you want to make sure that you have your liability at a proper amount. We're going to look at a couple of policies this evening, kind of go over what the loss income should be at, what your liability should be at. Okay? When you have a claim, your most common claim, of course, is fire, and a lot of us here in California, we're experiencing that now. A lot of insurance companies are going to be going back and looking at policies, making sure homes are properly insured. Okay? But you also have your wind and your hail for places down in Texas and other areas. You want vandalism coverage, water from broken pipes and appliances. They're a very common one that happens. And of course, you're always going to look at your insurance contract and talk to your insurance agent. Your insurance agent should be one of your best friends. That's the person that's going to protect you when you have an issue like a fire. Okay, liability. It's a very, very important thing to have on your policy. Covers everything. I mean, if your neighbor comes over and your water sprinklers are on, he slips and falls and hurts himself, that's going to be your liability coverage. You don't want to skimp on that. A lot of people will try and save a couple of dollars by having a low liability coverage like $100,000. You definitely do not want to do that. You want to get the $500,000 and get an umbrella on top of that. Okay. Also, if say your water sprinklers are running and you live on a hill, the water runs down that hill and into your neighbor's home, that's going to be covered by your liability. So you're going to want to make sure you have plenty of liability coverage. Here's a typical landlord policy. This is a property in Round Rock, Texas. It's a basic Marshall Reddick property. It's a one-story, 1,600 square feet, single-family home. You have your dwelling coverage, which is going to be about $213,000. You got your personal property, which is your microwave refrigerator, sitting at $4,000. Your loss of rental income. If something happens to the home, this is the money the insurance company will pay you while you are rebuilding your home, because your renter will not be paying you rent as he can't live there. So one of the things about your loss of rental income is you want to make sure it covers your rent that you have at your house for approximately a year. That gives you time to rebuild. Then you've got your liability protection for $500,000, medical payments at $1,000, and your deductible at about $2,000, 1% wind, hail. Your deductible will definitely vary how much your policy is going to cost each year. The higher the deductible, the lower your rate will be. Okay, some of the things that are endorsed. We use Safeco Insurance a lot. Safeco is a great company. We've been with them several years. We are in 23 different states with Safeco. One of the things that Safeco offers is what's called extended replacement coverage. So you're going to have your replacement cost that's going to cover rebuilding your home. Then you're going to have the extra coverage, the extended. It gives you an additional 25% to rebuild that home. And we're going to get into that a little more in depth. Then, of course, you have your building and ordinance. Everybody on this line that has a rental property or even a homeowner's policy, make sure you have building and ordinance. Not all policies offer that. And that's basically when every city has an inspector that changes what they're going to do. Maybe your GFI is not up to code. If your home burns down, you're going to need this coverage to bring everything up to code. And we're going to get into that a little deeper as well. So here's what we call the preferred landlord policy. This is really what you want. This gives you everything, not just the basics. So you've got your replacement cost. You've got your extended replacement cost, which is an additional 25% of your replacement cost. So it gives you an additional $53,000, almost $54,000 to rebuild. You have your personal property in there, your loss of rental income. If something happens, your rent is paid. You've got your liability. Then you have what's called extended liability protection. You want this for your property management companies, and pretty much every property management company will want this coverage on your policy. Then you've got your medical payments, law and ordinance, so you can put your home back together. So when the codes change, maybe the faucets change, maybe the piping does, maybe the electrical wiring, this will cover that. Then you have your deductible, and your premium comes in on this Round Rock property in Texas at $849 a year. And as everyone tells you, you see the lizard or the lady in white talk, if you package your stuff together, you will save money. If you have a landlord policy with Safeco and you put your homeowner's policy with Safeco, you'll automatically get 5% off your landlord policy. So it's definitely something you want to look at. Okay, here we're going to take a look at what happens when we get to a claim. So you have a scenario where the home burns down. The policy limit is $166,000. So they say that replacement is $166,000. Okay, most landlord policies will only pay up to the limit. One of the reasons we use Safeco is you can get the extended replacement cost. It'll pay up to 125%. So when they go to rebuild this home that they thought they could replace for $166,000, it actually cost $196,000 to redo. And your typical company would pay the $166,000. Safeco would pay the full amount, the $196,000. Unfortunately, that $30,000 difference, if you do not have proper coverage, comes out of your pocket. And if it's coming out of your pocket, it's going to take you forever to cash flow on that rental property. Let's take a more in-depth look at this. Okay, here we have the example again. Policy has a limit of $166,000. The actual replacement cost, $185,000. Then you have the additional cost of the $11,000 if you see on the left-hand side there in the blue. That $11,000 is your building code upgrade. That's additional to what it costs to rebuild your home because you had to bring your home up to code. And if you don't have that coverage, as a typical landlord policy does not, that $11,000 comes out of your pocket. So as we walk down, we have the extended replacement cost with Safeco, gives you the extra $41,500. So at that point, Safeco gets to the bottom line. They give you the replacement cost, the extended replacement cost, the building code upgrades, and at the end of the day, Safeco's paying the claim that's $196,000. Unfortunately, if you're not properly covered, you don't have the extended replacement cost, you don't have the building code upgrade, you're going to get paid $166,000, and you're going to be out of pocket $30,000. And anybody that does quick math knows that your cash flow each month is not going to add up to $30,000 right away. It's going to take several years to get back to where you're cash flowing just because you weren't properly insured. Okay, coverage exclusions. These are very important. A lot of people don't read their policies. You should read your policy. Also should talk to your agent. Your agent can explain your policy to you. A lot of people get their policy in the mail, tuck them in a drawer, and never look at them again. You should read it. You should ask your agent questions. First thing we're going to talk about is earthquake. Earthquake is not covered in your landlord policy. It's not covered in your homeowner's policy. Neither is flood. Those are separate policies you must purchase. So they're excluded from your policy. Also, workers' compensation is excluded unless you get the additional liability coverage. The freezing of pipes while your property is vacant, that's not going to be covered. And settling and sinking foundations is not covered. So these are things you need to look at, see where your coverage is, and talk to your agent on how you can get these coverages. More exclusions are pollution and mold, damage to unattached buildings. Now, this is if you're running a business. So if you have a separate garage, separate from your home, and you're running a business out of that, and you have a fire in there, that's not going to be covered. You need to talk to your agent and let them know that you're running a business out of there, and they can get you additional coverage that will help out with that. Okay, dog bites. Insurance companies vary on this. A certain breed is excluded with just about every company, and some companies exclude dogs altogether. Okay, certain cities, they have regulations and animal exclusions where if you're renting this home and a dog bites a tenant or a visitor, you're not going to be covered and you're going to be sued. Okay, backup of sewer and drains. A lot of people think if your sewer backs up that you're going to be covered for all the replacement in your bathroom or your carpets. It's an additional purchase that you need to make. You need to talk to your agent, make sure you have that coverage. It's offered through Safeco in several areas, and it's not very expensive at all. Okay, more exclusions. Damage by pests. Okay, if you have rodents that can get into your attic and are running around and having a great time, that's not covered by your insurance policy. You need to get a pest guy out there. Theft of anything that's not permanently installed. Pollutants, okay? Wear and tear, normal wear and tear. I just had somebody call me the other day, and they said, hey, my roof's 20 years old. Will the insurance company replace my roof? That's not covered. That's just normal wear and tear, okay? It has to be damage from a storm or another cause. Okay, another coverage exclusion, and this is an important one. Illegal manufacturing, production, or operation. So you cannot be growing illegal plants. I know California says it's somewhat legal, but it is not covered on your insurance policy. Okay, illegal manufacturing or operating of chemicals. You cannot have a renter that has a meth lab. You will not be covered. It's important to have a good property management company. Like Scott was talking about earlier, Marshall Reddick, they go and inspect their homes about every 6 months. It's part of their property management contract. If you have a property management company, make sure they're inspecting the inside of the home so that you know you don't have anything going on inside that would make your policy no longer be valid. Okay, we're going to get into some insurance tips here. These are great tips. I'm going to turn it over to Stan for a little bit so he can do the tips with you guys. But these are things that are really going to help you get your policy right where it needs to be so you have proper coverage.
Okay.
Oh, the second poll. We're going to skip the second poll and go right into tips.
There you go. Okay. So I am Stan Dreckman, and I'm going to talk to you about what we think are some very, very important things that you need to know, things that your typical agents are not going to tell you. This first one is a huge one. Vacancy clauses. You're always going to have some vacancies when you have rental properties, and you need to be aware of exactly what can happen to you. And what we're showing you here is our policy, the Safeco policy. It's broader than most companies will offer to you. All companies are going to have vacancy clauses. So if you have you're in between tenants, it's dead of winter, you can't get anybody in there. Certain things happen after 60 consecutive days of vacancy. You're going to lose your vandalism coverage, glass breakage, which isn't that big of a deal. Theft of burglary, attempted theft, damage to the building when someone tries to break in, fire damage. Now that's a big one. You can lose your fire insurance coverage if the property is vacant over 60 consecutive days. So it is exceedingly important. As Michael said right off the bat, your insurance agent, after your property manager, is probably one of your very best friends when you're working these properties. You need to let us know what's going on so we can then get you another policy to cover that gap. On my own property, I had to cover that for a while in between tenant situation. And so I slapped on a patch with another company who took care of it. I was covered. And then once the property is occupied, we're back and removing that temporary patch and moving on our way. One thing you notice at the bottom of the slide, it says this exclusion does not apply while the dwelling is being renovated and repaired. Basically, you're in between tenants, you're changing out the carpet, doing what you have to do, painting. Once you're through, then the clock starts ticking. This is what I'm going to call tip 1A. This also applies to vacancy. This is something where property management will 100% take care of this exclusion. So again, stay close to your property management company on this, and they know about this as well. Damage from a burst frozen pipe is not covered from the first day of vacancy if your property has not been winterized. So you make sure that your property manager winterizes your property. They know what that means. Keeping the heat on, turning off the water, doing all the adjustments they have to do. That is incredibly important. So you definitely want to make sure that your property management, well, they are going to know that it's vacant, but make sure that the property management company is in tune with you on this issue. This is what we call the equity killer. You can go out and buy yourself an incredibly inexpensive policy on an actual cash value basis. Actual cash value does not mean replacement cost. It means the insurance company will be able to depreciate a claim based upon the age of the property. So if you had a claim example, say you had $100,000 of damage, if you have an ACV policy, actual cash value policy, a 40-year-old home might see a 30% reduction in how much money you're going to get back if you have an actual cash value policy. Do not let yourself get sucked into that. Make sure your policy is a replacement cost policy so that we can pay the $100,000 of damage to repair the property. Again, very important claim, something that agents will use if you're playing dialing for dollars and trying to get the lowest price. Deductibles are a great way to keep your property premiums in check. These are our recommended deductibles. 1 to 2 unit homes, $2,500, 3 to 4 unit family homes, $5,000. Wind and hail, typically a 2% deductible. You might recall that on the example we gave you, it was a $1,500 deductible on the property and a 1% wind and hail deductible. In that case, that was the best price point. So we look at these when we work these policies for you, but what you see here is your best property, is typically your best price point for property. Where you buy affects your cost. If you notice the theme here, we're tracking the Marshall-Reddick program all the way through because they've figured this thing out. You're going to have higher rates in coastal areas where you have hurricanes, tornado zones, and certain coastal areas of Florida. Now, Reddick people are in Florida. They're strategic. The areas they're in, their property premiums are not expensive. Their premiums are very reasonable. They have the coverage you need from hurricane coverage right on down the line. Excuse me. And that's because of the area they're in. This is highly researched. They just don't pop themselves in a spot. They know what they're doing, tracks our insurance program, which makes for a very successful rental program for you. You get lower rates in what we call the relatively milder climates. And again, the Marshall people are there. Austin, Clarksville, and Oak Grove up there in the Kentucky and Tennessee, Arizona areas, California, Indianapolis in a cold zone, but it's a mild cold zone, and it seems to work well. We don't have freezing problems in those areas typically. Boise, you think that's Idaho, that's in a valley. It's a relatively mild climate. And of course, Las Vegas and Florida are hot, so we don't worry about those areas as well. Notice I said California except the brush zones. For those of you who are intent on buying properties in places like Simi Valley or Chatsworth or any city whose last name ends in hills, be careful, because you get in those brush zones, the premiums are brutal and the coverage isn't all that great sometimes. Also, what you buy affects your premium. The newer the property, the lower the premium. It's just very, very simple. You get new home credits, and those don't wear off until about 15, 20 years after the program. Roofs. When you're looking to purchase a property, one of the questions you always want to ask when you go east of Arizona is you want to find out how old the roof is, because in the central U.S. areas, they have more weather activity, and the roofs just don't last as long. Do yourself a favor, get yourself a property that has a newer roof on it, and you'll find yourself not only with a better rate, you'll find yourself with a better property. And then the sweet spot, the 3 to 4 bedroom, 2 bath, 1,200 to 1,800 square foot home. That's the sweet spot for insurance as well. You really want that. And as Scott said at the beginning, no pools. They look great on the rental piece that you put out on the internet, but they are a claim waiting to happen. You don't want that to happen. Other thing is you want to know about the property's claims history if you're able to find it out. We can find it out if we quote out the property. We're going to hit what we call the clue report, and we're going to know if that property has had a history of water leaks. You might want to know that if you're buying a property, if it's had 2 or 3 water leak claims in the last couple of years, you know, maybe that isn't the property you want to purchase. So we can help you have a really successful purchase in that way. So, how much coverage you buy affects your insurance. It's called all about asset preservation. So when you're purchasing insurance, how do you compare the other company's $100,000 marketplace quote versus what we would give you, say, as an example of a $140,000 replacement cost offer? First thing you got to ask yourself, is that $100,000 enough to replace the asset? Marshall Reddick's gotten you a great deal. You bought the property most likely in most areas for less than it's going to cost to rebuild in the event of a total loss. You do not want to allow your insurance agent to insure the property at the market value. Other than in California, it's probably going to cost you, I'm getting repetitive, it's probably going to cost you more to replace it than you're going to pay for it. Don't get sucked into the idea you don't need any more insurance than what you paid for it. Be smart. Make sure you have enough coverage to put your house back together again. Things like as Michael pointed out, the building code upgrades, the extended replacement cost factors. We worry about these things. We want you to have enough coverage to put your property back into shape. Here are some things that I guarantee you're not aware of this, unless you're a seasoned veteran investor. When you work with the Marshall Reddick mortgage broker, Reed Hazard, he's going to work with you to help you get your credit score in line. When you come to him, he'll do everything he can to improve it. But your insurance score, except for in California, will affect how much your insurance will cost. So that credit score is massively huge. Insurance score combines credit and loss histories to develop the rate as one of the major rate factors when we rate up the properties to give you a final premium. So guard your credit history so that you have a great premium. Pay in full mortgage. This is one of Michael's favorites, in fact. Insurance companies will often give you a discount if you pay the entire 12-month premium up front. Nice thing about when you get a mortgage and you're working on impounds with your mortgage company, you're paying your mortgage monthly. You pay your insurance premiums a part of the mortgage payment monthly. but the bank's going to pay your premium annually. So you get to pay monthly and yet reap the benefits if they pay in full discount. It's really, really good. One thing that you want to do on the number of units for a property, many insurers are not going to offer policies to you if you own more than 6 units. One of the really nice features about having our program is that we have one purchase source for you. You can buy properties through us, and we can write up to 20 units. That's 20 doors before we even have to ask permission from Safeco to go beyond that. Consolidation is nice. We get calls. It's not unusual to get a call and a person after 5 minutes in the call says, oh, I'm sorry, that was the other agent. Consolidate it, get as many discounts as possible, have one call center point to talk to. Tenants and dogs. I love dogs. You will not find a greater dog lover than me. I am fanatic about dogs. I love them. They're tough, though, if you're a landlord. Always require that your tenants buy, at least if the jurisdiction will allow you to do this, require that your tenants buy a renter's policy to cover liability for their own dogs if the dog bites anybody, and you want them to have a $500,000 limit. This is something that renter really should have anyway, because the renters are not going to be covered for their own personal liability or their own personal stuff by your policy. You want them to make sure they have liability coverage so that if the dog bites somebody, their policy is the first line of defense for you. When you can, avoid renting to tenants with dogs who have whose breeds have aggressive biting histories, or if that particular dog has a biting history. I know at some landlords where the jurisdiction allows will actually ask a prospective tenant to bring a report in from the vet. It gives you typically a good idea of the dog's history as well. And this next item is where we like to talk about all insurance policies are not created equal. We showed you the property side. This is the liability side. Many insurance companies have pure animal liability exclusions, which means they don't care if you have Fluffy or if you have Gruff. You can have a mean dog. You can have the nicest dog on the face of the earth. If they have a pure liability exclusion for animal bites, and any dog can bite, you don't have any coverage for that. So be careful of this. This is where dialing for dollars can get you into trouble. You want to go through a market that will protect you as much as possible. Now, we throw this little last tidbit in just in case you have a tenant who has a dog and really wants to keep the dog, but they're having a hard time getting insurance for it. Tell them to call Fido. They can look up Fido on the internet. That will get them liability insurance for a dog breed that's tough to place. You're doing your tenant a favor. That way they don't have to give up their dog. Tenants themselves can be challenging. Again, we want your tenants to buy renter's insurance. It's for their own property and their own liability protection. Again, you are not responsible for this. And where tenants can also be difficult is if a tenant is evicted, sometimes they get a little vengeful. And they're going to get mad, and they may vandalize the home, or they may throw a block party on the last day before they leave. Katie bar the door. So most insurance companies will not pay for this kind of damage. Our Safeco product will sort out vandalism against wear and tear. A good example would be is if a guy has a motorcycle and he changes the oil on the carpet, that's wear and tear. That's called just owning a property. But if they punch out the walls in a massive block party, that's vandalism. Our Safeco product will pay that. Many, many companies will not pay that kind of coverage. Loss of rental protection. Michael spoke about this. Rents are going up. Typically speaking, our 10% automatic rental grant of coverage is enough. That rental income coverage usually is going to cover a property. What we're starting to see, though, in the Texas area is those rents are increasing, and the rental income coverage, the rental income you're actually getting might outstrip the automatic coverage you're given. So let your agent know how much rent you're drawing off of the property so we can make sure we can increase the rent to cover it. This typical property, you might be pulling $18,000 a year rent instead of the $15,000 we automatically grant you. It'll probably cost you $9, $10 to increase your rental coverage up to the $18,000 that you need. Again, we mentioned, make sure you make us good friends, because we want to know what's going on with your property. I cannot tell you how many times someone will call us and say their policy got canceled and they can't understand it. First question, the very first question we're going to ask them is, because we look at the policies and we're talking to them, we realize that it's the lender payment structure of the policy. The lenders always pay the premiums. But loans are sold. That's a big business among lenders. This is the number one cause of policies canceling, particularly after the first year the loan sold. Nobody told us. We billed the old lender. So that can create a problem for you. Sometimes forcing a rewrite, and then the new lender will charge you an astronomical rate for what they call a forced place policy to cover the times when the policy had a gap. So you want to make sure that doesn't happen. Make sure we have the right information. Do not give us the address of where you send your mortgage payment, because the insurance address is always different. You get that from your loan company. Give us the updated information. We will update the policy and get it taken care of for you. I like this question. When is $1 million less than $500,000? Sounds almost impossible. This is when it's less. Many insurance companies, and it's not so much in California, but you'll see this a lot in the Midwest. Many insurance companies are going to write a landlord policy on a business form. And what they do is they will write a $500,000 occurrence with $1 million annual aggregate. What that means is the most they'll pay on the policy over the 1 year life of the policy is $1 million. Our Safeco product offers the following liability: $500,000 per occurrence. There is no aggregate. In other words, you could have multiple claims arising from your policy during the year. Highly unlikely as it is, we'll keep paying up to $500,000 each time. So there is a difference. It's a minor difference, probably not one you'll ever run into, but for pure asset protection, this is when $500,000 is less than $1 million, and it's important to know this. Here's a different example of a policy. We showed you one before of what a personal, typical landlord policy would run. This is a very common, particularly in the Texas area, business style policy. It's with the Maxim Insurance Company. Maxim is owned by the Hartford, so this is not brand X, okay? This is a big insurance conglomeration. And our Safeco, being a Liberty Mutual company, is also a big conglomeration. On the Maxim policy, you are required to maintain a minimum of 80% of the replacement cost of the value, or they will depreciate the claim. So they're saying, yes, they're giving you a replacement cost, but only in most cases, not in all cases. Our policy is a replacement cost policy, period. The Maxim, your commercial forms, typically, unless it's specifically endorsed onto the policy and you have to ask for it, it's not automatic grant of coverage. You are not going to get the code. I'm dropping down the third box here, the code protection. They're going to give you maybe this little automatic amount, but you're not going to get more than that. Our policy, we're going to give you 10% of your building limit. So if we have $300,000 of building coverage, you have $30,000 of code upgrade coverage. You can increase the Maxim policy, but you have to ask for it. And then on your commercial policies, you almost always are never going to see the extra replacement coverage to replace the structure, whereas we are going to give you, except for the state of North Carolina, we're always going to give you 125% on this landlord policy, and that's an important factor to have. Claims often go into the extra structure limit. Maximum policy on their commercial policies also, in many of them, they're not going to automatically give you the rental income coverage that we give you. We will give it to you automatically. Again, if you go into commercial policies, you have to ask for it because they're a different structure. Theft coverage, they will typically in commercial policies exclude theft coverage. We will give theft coverage, as we mentioned, everything as long as it's nailed down. Someone might steal, the midnight supply company might come in overnight and steal your HVAC system from the outside of the property. We will pay for a new one. And roof damage. This is very typical of what you're going to see, particularly in the Midwest. Many insurance companies, particularly your commercial companies, are going to limit replacement cost on a roof repair if the property is over 15 years of age. Once it hits over 15 years of age and the roof has not been updated, they immediately go into the depreciation. And if you depreciate a property that's 15 years old, it's going to be probably a 60 or 70% depreciation on the roof replacement. That's huge. We are going to make sure that your roof damage is replaced, and we don't have to worry about the actual cash value. We are going to replace the roof for you. Dog bites, we will cover it. If we will underwrite the exposure, if we know you have certain breeds, we aren't going to want to write the policy. Maxim is one of those companies that has a complete animal exclusion. And we have full occurrence limits on our properties. And again, the Maxim has the aggregate limit policies. There's significant differences between policies. Policies are marketed as being the same. They are not. They are hugely different. And so we have your ultimate insider tips for you that we want to give you. Pricing is strategically use your deductibles uniformly across all the insurance policies. And by this, we mean not just your landlord policies. Extend those higher deductibles across every policy you have, your home, your car, your landlord policies, and you're going to find yourself paying as little premium as possible. Always ask for a comprehensive review of your insurance so that you know your vulnerabilities. And this is a non-insurance insider tip. Professional property management will keep you out of all kinds of trouble. Make sure you have it. Do not try to manage properties yourself. If you do, I can almost guarantee you, from an insurance standpoint, you are cruising for a bruising. It's going to be a tough time for you. Michael's going to pick up the rest of this seminar from here. Thank you.
Thank you, Stan. Those are great tips. I hope you guys caught all of those, maybe took some notes on them. I want to touch real quick on umbrella policy. An umbrella policy is exactly what it sounds like. It's an umbrella, so it covers all of your assets. It's one of the most important insurance policies you can get. They start at about $1 a day, depending on your assets, and they go up from there. But it gives you $1 million, and you can increase that as well, but it'll give you $1 million of liability coverage above and beyond what you currently have. And that's super important, especially on the landlord policy. You get $500,000 of liability coverage, and you have a claim that's more than $500,000, your umbrella policy will kick in and cover that liability claim. I just wrote a $5 million policy for somebody that has 11 rental properties, and we're going to start looking at maybe increasing that as well. And that covers every single rental property he has, covers his autos and his primary home. So anywhere that there's possibly a liability lawsuit, he has this additional coverage that will help him out, okay? And with Safeco, when we write you a Safeco umbrella policy, you'll get discounts on your auto, your home, your landlord policies, and it's a real umbrella policy. That means it goes worldwide with you. A lot of umbrella policies will cover you when you're in the state you're in, or even in the United States. The Safeco umbrella policy will go anywhere you travel in the world. So if you're a traveler, I would seriously look at getting an umbrella policy with Safeco. And once again, combine all of your insurance. Make your auto and your home and your landlord policies and your umbrella with one person, one carrier. That way it's one phone call, you get all your coverages, and you get all of your discounts. Okay? This is how it should stack up. You have your homeowners and your vacation home. You have your auto. You have your rental properties with your landlord policies. You put your umbrella over the top of that, 1 million or 3 million, and you have all your policies together, getting all of your discounts, and then boom, you're saving money with all of them. Super important. All companies offer this. Safeco is one of the best when it comes to discounts for landlord policies, homeowners, and autos with the umbrella, but everybody offers it. Okay? Once again, we're Huggins Dreckman Insurance. We work with Marshall Reddick. We really love their product. Like Stan said earlier, they handpick their areas and their product, and we love everything about what they pick. It's exactly what we look to insure, and a lot of our tips you can find in the Marshall Reddick products. We work with Safeco very directly. We've been with them several years. We give you, as a Marshall Reddick person, a free 24-hour, 7-day-a-week service line dedicated for you guys to call at any given time. if, say, you're laying in bed at 2 in the morning and you go, oh, I forgot to get a policy on my landlord property, call them. They'll get you a policy right then and there. They'll let us know in the morning. We can follow up with you. We, of course, also have our offices. We have an office down in Los Alamitos, and we have one up in Anaheim Hills. You can give us a call at any time. I'm extension 1700, Stan's 1500, and Stan pretty much is going to answer that phone at all hours of the day. I maybe will just answer during my work hours, but I hope if you guys have any questions, you can go ahead and post them now. And I think I'm going to bring Denise back in and let you start back up with the Marshall Reddick.
Thank you, Michael. Thank you, Stan. That was very valuable information. I hope that our audience found that to be so as well. I certainly hope that you appreciate and can use the information that we just went over. We always strive at Marshall Reddick to provide our investors with ongoing education, videos, webinars, articles, guides that you can find on our website. In case you might want to listen to this or refer to any of the information again, this will be recorded and will be on our website in the next 24 to 48 hours, as are all of our seminars and webinars from the past. And like I said, I hope you found this informative, and feel free to reach out to either myself or I can put you in touch with Michael and Stan should you like to visit a quote or any other questions you may have in relation to insurance and your asset protection. Please feel free to reach out. I'll be happy to provide you their information in case you didn't grab it. And also, as I mentioned to you before, I would be happy to talk to you also about a complimentary consultation if you're looking to get your investment portfolio started. I'm here for you to go over your criteria, your goals, and help you identify what direction we can help you with. Again, thank you so much for joining us this evening. I hope to hear from you. You will get a follow-up email from me, and hopefully we'll connect soon. Be happy to answer any questions or help you any way I can. I think it's time to wrap this up. Thank you for the last hour that you joined us, and again, I hope you enjoyed the information provided. Have a good evening, everyone.
Thank you, Stan and Michael, and thank you, everybody, for joining. We hope you enjoyed the presentation.
Good night, everyone.
Thank you. Good night.
Bye, guys.
Night.